Tommy.
How are you? How are you?
Fine, very well. How about
Okay.
you?
Yeah,
Okay.
good. Everything good. Yeah.
Yeah.
You bring this book.
Yeah, of
Okay.
course. We have to review this book nowadays, right?
Yeah, right. You're right.
This is
Yeah.
interesting book, I think.
Yeah, I
Yes,
think so.
agree.
Okay. Welcome to.
Cuan Podcast.
Okay, so our goal today of our podcast is review the book of a random book, Walk Down to Wall Street. Is right?
Yeah,
Yes.
it's a good book, Finda, because I think especially for beginner trader investor to know how to make decision in stock, and then investor from this book know how to make decision, and then obligation and others also how to mitigate the worst scenario.
Oh, I see.
That's interesting.
Yeah. In this book, Barton says that this couldn't be further from the truth. He shows that even a blindfolded monkey throwing darts at stock listing would outperform their professionals. Do you believe it?
Yes, I agree.
Yeah, true. Wait. Hold on. Fasten your seatbelt. We will discussing some takeaways. Won't be any less provocative.
Okay.
Okay. For the first, we are talking about the fundamental analyst doesn't outperform the market. In beating the market, professionals tend to rely on one of two strategies:
Okay.
the fundamental approach or the technical approach.
Let me think. I think the investor who use fundamental analysis are as their vehicle for earning money in the market believe in the so-called from foundation theory. In this theory, we see some intrinsic value, and that price of an asset typically over or underestimate this value. The intrinsic value can be determined by discounting all the future cash flows and investment. And discounting is the process of turning future earnings into today's value. Remember that dollar today is worth more than a dollar tomorrow. Do you agree?
Yeah.
Really?
Yeah.
Well, how to calculate the correct intrinsic value of a stock as a fundamentalist strategist, Pak Tommy?
Okay, as far as I know, to calculate the current intrinsic value of stock, a fundamentalist must assess the following four. The four are as follow: earning growth rate. That's the most important part of the calculation revolves around the estimation of future growth rates of earnings. And the second, the expected dividend payout. The higher the dividend payout, the greater the value of stock. Everything else equal.
I
That's as far as I know.
see. Well, what about the degree of risk and future market interest rate, Pak Faiq?
Yeah, I continuing with the Pak Tommy. The third one, Pak Tommy, Finda, is the degree of risk. Risk is the important factors to make some investment. So everyone prefers an investment with the lower risk of losing money. But in order to have the higher investment, they want to lower risk. But we see the opposite one. Would you prefer to get 100 million in your hand now, or to flip a coin 200 million? I thought so. Riskier investment must therefore be compensated with a higher potential reward. So basically, if we want to higher reward, of course, it will be the higher risk. Yeah, that's the third one.
So It means the higher the risk-free rate of return,
Yeah.
the higher the return should be expected from any other investment. Is it?
Yes, it is.
Yes, I remember that. As our Professor Roy mentioned in our class.
Yeah, you're right.
Yeah, Prof
I
Roy.
remember.
Yeah, I remember
Yeah.
that.
I see. Approximately 90% of the analysts of Wall Street are fundamentalists.
Mm.
So, and then why technical analyst doesn't outperform of the market either, Pak Tommy?
I think technician, as the people believing in the technical analysis are called, trust in the castle in the air theory. As opposed the fundamentalist view, this theory argues that intrinsic value is of less importance. Instead, what's most important is the behavior of the investment community. Crowds do not act rational, and they are susceptible to building castle in the air in the hopes of acquiring wealth. That's my opinion.
Here's a simple analogy of how it works. You and 100 other people have randomly been chosen to decide who the three prettiest girl in town. So the one whose selection is most like that of the crowd wins. If you are a smart player, you realize that personal opinion doesn't matter in this competition. The better strategy is to try to anticipate what your competitors will answer. The technician usually will use charts of stock prices and trading volume to determine future prospect of castle building.
There are three primary reasons as to why technical analysis is stated to work according to Malkiel. First, price increases are self-perpetuating increases in price tend to cause additional increases. People cannot stand waiting on the sidelines when others are making money. Therefore, demand increases with every price increase, which causes price to go even higher, creating a dangerous upward spiral.
Yes, the second and the third one are second, unequal access to information. Insiders are the first to know about changes in a company. Then comes the friends, the families of these people, then the professionals and their institutional capital, and finally, poor people like you and me. Just are supposed to give information about when either insiders or professionals are buying so that you can make your move before the rest of the market does. And the third, investors underreact to new information. The stock market will react to new information gradually, which results in longer periods of sustained momentum.
I think I doesn't agree with you, bro and sis, because you know what? Malkiel and other advocates of the random will counter argue with this. Can I explain to you?
Yes, please.
Okay.
Done.
Okay, here's the argue. The first thing is sharp reversals. Uptrends can happen drastically, which may cause the technician to miss the boat. When an uptrend is signaled, it may already be too late. Okay. The second one is profit maximization. Let's say that company stock is at 20 bucks, and then one day it develops a new product that increases the value of the company of $30. Before releasing this information, wouldn't it make sense for the insider to buy the stock until $30 has been reached? Every dollar they invest before $30 is an instant profit. That's it. And then the third theory is the techniques are self-defeating. Once people know about the techniques that are supposed to efficient, the technician will compete each other out. Other trader will try to anticipate certain signals that they know that everyone else is buying or selling to. That's it.
So approximately only 10% of the analysts of Wall Street are technicians.
Yeah, that's
Yeah.
the fact.
Yeah.
You know what, guys? Human psychology makes even more difficult to beat the market.
Oh, okay. Now you mean we talk about the human psychology, Patomi,
Yes.
on this topic 3?
Yes, correct.
Okay.
Okay. I continue. As if the aforementioned reasons weren't enough, there are 4 factors that professionals and individual investors alike face when they are trying to beat the market, which further reduce their chance of doing so. Overconfidence, that's part of human psychology. This bias causes mortals like us to be over-optimistic about assessment of the future and to overestimate our own abilities. Bias judgment. Humans tend to think that they have some control in situations, even though the situation is completely random.
Yes, also about the herd mentality. This might be the most obvious one. Herd mentality is the primary reason for many of the stock market's greatest bubbles and following meltdowns.
And we can consider last is the loss aversion. Loss aversion is another psychological factors that makes it difficult to us to stay rationally in the market. Yeah, people are going crazy with this situation. I think loss aversion. Losses are considered far more undesirable than equivalent gains are desirable.
Well, we are continue to the topic number 4 about the random walk and efficient market hypothesis. Now, if neither fundamentalist nor technician can predict the market, who can predict the market? Fundamentalist or the technician?
Okay. I think, according to the author, no one can. Why? Because the development of the market is random walk.
Well, let's continue to topic number 4 about how.
No, honey bunny sweeties panjang.
Sorry, Padu. It's our last topic
Yeah.
today.
Yes.
5 is about how you can beat Wall Street, right?
Yeah.
Okay. On the part of how you can beat Wall Street, because of the flaws of the 2 primary strategies of investing and because of human psychology, Wall Street professionals have been unable to beat the market historically.
Yeah. But yeah, I think this might sound too simple to be true. And you know what? And it's like you must also consider these 5 core principles for asset allocation also.
What is that?
Okay, how to beat the Wall Street? The 5 core principles for asset allocation is 1. Risk and reward are related. So volatility is measured by how much the return typically differs from its expected value. A higher volatility means a higher risk that you might be forced to sell with a loss at a later stage and may imply that your investment has a higher risk of defaulting. Yeah. Here is a list of assets, their expected returns and their volatility.
So what else about the length of holding time decreases risk?
Yeah, that's right. The second one is length of holding time decreases risk. If we are more patient to hold, if we are in bad condition and others bad psychological, and these tips is may be useful to you to decreasing the risk. Okay, the longer you hold on to a position, the more likely that it will be performed according to its expected value. In other words, the longer you can hold on to an investment before you need that specific money, the less risk you take. We can see the example for who is the person, the famous person, investor in Indonesia, Lee Kong Ho.
No. You
Yeah.
mean Lo Keng Hong?
Yeah, I
Lo
mean
Keng
the
Hong.
Lo Keng Hong. Yeah.
Well, the third consideration about the core principle for asset allocation, such in the book about the US dollar cost average. What do you think about it?
Okay.
Tommy?
I will continue to the next points. Use dollar cost averaging. Dollar cost averaging means investing the same fixed amount at regular intervals. And fourth, decide your tolerance for risk. How much risk you can tolerate depends on your financial situation, your age, and your psychology. If losing your investment money means that you will have to drastically change your lifestyle, as in the case of a retired living from his or her investment income, you might want to downsize risk. And
How about the last one?
the last one, you mean the rebalancing?
Yes.
Yes. The last one, rebalancing can reduce risk and possibly increase return. Let's say that you are 25-year-old. You are then suggested to keep 70% of your asset in index fund and 15% in bonds according to the examples presented before. If stocks have been overperforming lately, you might end up with 80% index bonds and 5% bonds.
Okay, friends, I think we have to conclude our discussion.
Yeah.
So
Yes.
we have a discussion. I think 5 topics.
Yes.
Yes.
5
Yes.
topics,
And
and I
really-
think it's so important to us to make a conclusion from these 5 topics. What from your point?
Okay. May I can conclude the
Okay.
summary of the book what we was
Yeah.
read.
I'm curious of
That
that.
is, the fundamental analyst has a tough time beating the market for the
Okay.
first,
Okay.
and second, that technical analysis doesn't seem to be a winning strategy either,
Correct.
Okay.
and the third, that beating the market is made even more difficult
Mm.
due to human psychology. Also, that the future market development is essentially a random walk and therefore it cannot be predicted.
I
And
see.
the lastly takeaway is a hopeful one for the individual investor, as it suggests that he can easily beat the average analysis on Wall Street by simply buying and holding the market index. I think that's all for the concluding our
Okay.
discussion today, and we can more read Wall
Yeah.
Street books another.
Okay,
Let's
guys.
go.
I think we have to shoot to permit with our audience.
Yeah,
Okay.
close. Wait, we
Okay.
have to close our podcast today about reviewing the book Walk Down on the Wall Street.
Yeah.
Thank you for your time, guys, and
Thank
see
you.
you in the next podcast.
Bye bye.
See you. Bye.
Salam
Cuan.
Psycho.
By the way, I'm still thinking about the key takeaway from a random walk down Wall Street book.
What
I
is that?
think, I think I got 2 point key. The first thing is making money in the stock market is not as difficult as do you think?
Yeah, I think so.
Agree.
And the second one is the emotions impact our investment decisions. Oh,
Yeah.
okay, okay.
Yeah, I think so about the emotions impact. It's really impactful about our decision.
Yeah.
May I add some key takeaways from Random Walk Down Wall Street is about every stock has a certain value. Never pay more than it's worth.
Yeah.
Yeah.
That's the
We agree about the key
Okay.
takeaways. Yeah.
yeah from this. Okay, let's eat our food.
Okay.